Hi everyone, it's Amit. So in this video, what I wanted to talk about is how much home can you afford? This is actually one of a 4-part series that I'll be releasing. So this one is how much can you afford? The next one I'll talk about is what is the home buying process? After that, I'll cover off on refinancing and how to go about doing that. And the last thing I'll cover off on is renovation related expenses and how do you pay for it. So it's going to be a 4-part series, so definitely subscribe to the channel and ring the notification bell so that you'll be notified when I release those videos, which should be in the next week or so. So before we get started and too far into it, this is a personal finance channel where we're focused on enhancing your financial acumen so that you can make better financial choices. So without further ado, let's get cracking. So the home buying process is typically a very emotional process. It starts with an emotional journey and then it becomes a financial journey towards the tail end of it. But what usually happens is people go around saying that, okay, I want to buy a home, right? And it usually is influenced by some external influence, right? So there may be their friends or co-workers or whatever that are buying places. So they say, well, I should probably buy a place now as well. So once they're done through that, they typically get an assessment of how much home they can actually afford. It's usually a back of the napkin type of thing, right? So there's no real assessment or real analysis of exactly what that is. It's more like, oh, this guy spent about X amount of money on his home. I probably make about that much too, so I can probably spend that much as well. And then they start going and start clicking on their computers and they go on various websites. They go on Zillow or Trulia or Redfin or Realtor.com or whatever, right? Or usually a combination of all of them, and then they start plugging in numbers, right? So they say, oh, I can afford an X amount of house, I would like this much land and these many bedrooms and this many this and that, and then it spits out these results and they start clicking through it and they're clicking and clicking and clicking, and then they start thinking, I wonder what will happen if I just increase my upper limit on this search bar by say $50,000, or if I take it up a little bit higher, a little bit lower, what happens? And then they start looking at all the houses, all the results that keep popping up, and it gets more exciting. They start saying that, oh my goodness, I can get so much more. Oh wow, look at this, fully done kitchen, and look at this and look at that. And then what it usually results in is one of two things. Okay? When they actually go into their qualification process, i.e. going through a lender and basically saying, hey, how much am I pre-qualified for? What the lender comes back and says is a lower amount than what they were expecting. So there's some level of disappointment there. Or the second thing that may happen is they actually get approved for that loan, for that particular amount, or they get pre-qualified for that particular amount. And then what happens is they realize that, wait a second, this house is really expensive and I can't do anything else that I want to do, right? So it becomes an overbuy type of position, if you will. So that is also a less than desired outcome. So it's important to do some level of analysis and some level of assessment before you go through all this process and get your hopes up or setting yourself up for disappointment. And what are those rules or what are those guidelines that are out there that would recommend how much it is that you can spend on a home? So let's talk about those. So there's really 3 things in terms of these guidelines that is frequently recommended, okay? The first guideline is, I would say, the 30% of net income rule. It's exactly what it sounds like, okay? So your net income is your gross income less your taxes. Another way of thinking about it is it's the amount of money that you're actually getting into your bank account, right? That's your net income. So you take that amount, right? And then you do about 30% of that, and that is the maximum amount that you can spend in any given month on your home-related expenses. So when I'm talking about home-related expenses, I'm talking about everything, right? Your principal, your interest, if you have homeowners insurance, that. If you have homeowners assessments, HOA fees, it includes that too, right? So we're talking about the whole enchilada in terms of how much it is that this home is going to actually cost you, okay? So it's 30% of your net income. Now, I know, there's other more conservative schools of thought out there, okay? Some people say, I think Dave Ramsey's a proponent of 25 to 28%. That is kind of like his recommended guideline. I think personally that's a bit conservative, right? But I think you can go as high as 30%. So that's kind of like the first rule of thumb, if you will. The second rule of thumb is debt to income ratio, okay? And this is the rule that typically lenders use to determine whether you would be qualified for a loan, right? So what that basically says is you take all of your debts, every last one of them, okay? So you take your student loan debts, your credit card debts, if you have any car payments, that's an obligation, you take that into account as well. So you take out all your debts, okay? And then you divide that by your income. If that result is in excess of 36%, the odds are lower that you're going to get pre-qualified for that loan, okay? So you want to keep that under this whole 36% number. Now I know there's lots of banks and financial institutions that may go a little bit higher than that, but for all intents and purposes, the underwriters after the 2008 crisis, they have brought their limits and they have made their underwriting standards a lot more challenging. Okay, so they want to keep it right around 36%. So that's the other rule of thumb in terms of figuring out exactly how much it is that you can afford as it relates to a home. The third rule of thumb is called the 3 times of your gross income guideline. Okay, so you take your salary. So let's just say it's $50,000 a year, right? So what this would suggest is you can afford a place up to $150,000, which is basically $50,000 times 3. Take any number, you multiply it by 3, right? So this is another kind of like rule of thumb, right? Which would give you an assessment in terms of how much home that you can afford, right? And the way that I've kind of like staggered this, right? So in terms of the 30% of your net income rule, or the debt to income less than 36% rule, or this 3 times of your salary rule, they're kind of like in that order for a reason, right? So first one's most conservative, and the last one is the least conservative, and it allows you more bandwidth in terms of how much you can actually afford. Again, these are just guidelines, right? They're supposed to be ways to figure out exactly how much it is that it makes sense for you to afford. Now, I know the reaction is going to be, dude, you're crazy, okay? It's going to be, there's no way that these rules are going to be applicable in the place that I live. Okay, I live in New York, I live in San Francisco, or someplace in California. I live in these really, really expensive areas. People in those areas, they're looking at spending 6 times, 7 times, 8 times their amount, right? Their salary amount in terms of buying a place. To be blunt, right? I think that's absolutely crazy, right? So you have 2 options in those cases. Either you bump up your income to get into these guidelines, right? Or secondarily, you move. You get the hell out of those states and those cities, right? If you can't afford it, right, it's a problem, right? Because you're not going to be able to have enough money such that you can use it for other purposes, right? So what is another purpose? Like your retirement as an example, right? You're not going to retire. You need cash flow coming in when you retire. It's not just about having a place that is even potentially paid off. You need a place to live, but more importantly, you need money coming in to offset those costs and to supplement yourself as you go through retirement. If you're planning on putting your kids through college, you won't have any money for your 529 plan. You're going to have no money for your expenses. I mean, you're just going to be house rich and nothing else. So you need to move, right? Or you need to figure out a way to get more income. Those are the only 2 ways, and then you need to bring these numbers within the guidelines that we talked about. I know there's lots of people that would say, well, I like living by the beach, right? Or New York is the greatest city in the world because they saw it on a t-shirt somewhere, all right? There's all these things that are out there, but the reality of it is you want the beach, you take a vacation, okay? You want the weather, you get out of California. There's other states that you can live in, like Florida and Texas, which have just fine from a weather perspective. Nevada, Arizona. There's lots of people that are leaving California and moving to Nevada as an example. At least that's what you hear about. I mean, Elon Musk moved from California to Texas. I think that was the most recent news in terms of a big person who is moving into that kind of world. All right, so that's what I'd say about weather. And there's plenty of great cities out there. Okay, so you've got a slew of them across the United States and even abroad that are all considered great cities. One other thing I'll quickly say, right, is when you're going into this home buying decision or this home buying journey, right, you need to be able to put 20% down. You have to put 20% down, otherwise you're going to get tapped on for private mortgage insurance, or PMI. PMI the best way to describe PMI is taking your money and just burning it, right? If you want to just burn your money, go ahead and put less than 20% in and pay PMI. PMI is basically a cost which lenders put on you, right? Just to make sure that you have a vested interest in that house. Lenders perceive it that if you have less than 20% put into that house, you're not committed to it. You may leave the house, you may foreclose on it and leave the lender with the bag, right? Nobody wants to be left with the bag in the end, right? So that's how they perceive it. If they want you to get up to 20%, once you get up to 20%, they'll say, all right, we'll waive the PMI at that point in time. Therefore, it's in your best interest to put 20% down as you're going through your home buying process. The other thing I'll quickly say is in terms of terms, right? So what I mean by terms is the duration of your loan. If you're in your 20s and your 30s, what I'd say is you should get a 30-year loan, okay? Especially in this ridiculously low interest rate environment. And the reason I say that is take your surplus cash flow, right, and put it into investments, because you're going to realize 7, 8, 9, 10% on the stock market against like paying 2 to 3% on your interest on your loan, right? So what I say is when you're 20s, 30s, do that 30-year loan. That's perfectly fine, right? Once you start getting into your 40s, start paying more. Start paying more towards that loan so that you can pay it off a bit faster, okay? But now if you're somebody that's in his 40s or his 50s and is looking to buy their place, right? If you're in that category, get a 15-year loan, right? Because the worst thing that can happen is you go into retirement and now you've got a mortgage to pay off, right? Not an ideal situation, not an ideal circumstance. So we want to avoid that from happening as much as possible. So that's it, right? At least in terms of how much you can buy from a home perspective, it's just follow these 3 rules, right? They'll give you a pretty accurate estimate in terms of how much home you can afford, right? So it's the 30% of net income rule. It's the 3 times of your gross income or your salary rule. And then there is the debt to income rule, right? So which is basically debt to income less than 36%, you'll likely get a loan in your name. So those are the rules that I'd follow. That's pretty much it. I hope you enjoyed the contents of this video. If you like the contents, definitely smash the like button or the thumbs up button. Subscribe to the channel as well. We talked about that. And I'll see you in the next video where we talk about what is the home buying process. I'll see you soon.